Good evening, everyone. I'm Soni Patnaik. Welcome to HDFC Securities webinar once more. So, in today's webinar, we have taken up the subject called Volatility Bells Learn to Hedge. So, earlier in my previous webinars, I have separately explained exactly what hedging is, how it is an insurance to protect your losses in current market scenario. So, in today's session, we are going to combine the volatility and the hedging where we understand what volatility is and what and how can we hedge, how can we reduce our cost when it comes to hedging, what are the different strategies that we can do when it comes to hedging. See, when we talk about volatility is a broad subject, it's a broad term, it has a lot of things to go to. People can exactly people can uh, convey volatility with probably volatility, skews, the uncertainty, the market. There's a lot of things to cover. So we are going to try to cover all of those things in today's webinar in a very short, crisp, to the point note wherever it is possible. So I think that's all. So let us, move on to my screen. So first, we'll try to understand the common psychology behind bulls and bears, as we know that this market is driven by bulls and bears on a constant. So why these animals have been chosen is a very, it's a kind of a small certain information that I would like to share before we get ahead with the entire session. So the reason is when the bulls they attack with their horns, and the moment they attack, they swipe the victim to the up. So that is the reason it's a bull market, because when a bull is attacking, the person or the object that it is attacking, it moves up. So that is how it is known as a bull market. Or and the reason why it is a bears market, or why have we chosen the, why stock market is represented by this bears and bull. So the bears would be because when a bear attacks, it attacks with its paws. So it usually attacks from up, and it drives you or swipes you down from up to the ground. So that's the reason why it is a bull and a bear market. So bullish is where the market is going up, and bearish is where it comes down. But how do we understand exactly what is happening between the both? So a lot of people can also generalize volatility, that it can also be considered in a way that it's a constant fight between these bulls and bears. That is why the volatility majorly is caused or is arisen. That's one of the reasons. So a very common basic analysis would be to understand something called a bull push and a bear push on which days. So let's say, for example, if it's a bearish market for today, if market was down by 100 points, it's a hypothetical example. So we would call that it's a bearish market for the day. So the analysis would be to understand right from the opening of the market to the high point that it could make. That point, that difference between the opening and the market and the high point would be your bull push. How strong were the bulls on a losing day to take the market higher, and then exactly again where it comes back to closing? So similar or its vice versa would be the bearish push on the winning side or a bullish market. If the market is if the market is bullish, if it's up by 100 points or so. So a common analysis would be from where it opened to the low point that it made during the day, and again from the low point where it went up and closed again. So this difference between the open and the low point would be your bear push. So this constant fight between the bull push and the bear push is exactly what causes uncertainty in the market. And by uncertainty, I mean volatility. So when uncertainty rises in the market, there's a continuous swings in stock prices. Continuously, the prices would be moving up and down. and that can be worrisome. So how to protect yourself, protect those losses happening, how to hedge your positions is what can be a solution to this uncertainty. So smart investors, they do not risk it, they hedge it. And this is exactly what we are trying to understand from this webinar session today. Let us first understand again. I have explained volatility in many of my webinars before. I would still take it in a very simple fashion to make you understand exactly for what volatility is. In simple layman term, it is nothing but uncertainty in the market. By uncertainty, it means that the risk that is related to the change in the value of the stock or the security. So if I say that the stock has high volatility, it means that it can change dramatically over a period of time. It means that it can make a lot of ups and downs, ups and downs. But if the stock has a lower volatility, it means that it will not fluctuate that dramatically and it will tend to be more steady for a period of time. This is what we understand by volatility. Whether the stock is moving a lot up and down continuously, or is it steady across a period of time. That is the amount of uncertainty we're talking about. So your volatility, we know volatility index is known as VIX. Many people would also refer to it as fear index because this is a very important parameter to understand market. One of the subsets of this volatility is also known is one of those subset is something called implied volatility, or in short we call it as the IV. It is nothing but it is the projected volatility. It will tell you how much is the uncertainty going to be for this particular stock in the futuristic date. How expensive are the option premium going to be is something that is measured by implied volatility. Whereas your historical volatility, or HVs, they refer to a statistical volatility. It means it's a past historical data that is already calculated, and it's showing the historical data of the entire stock's volatility over a period of time. How much has the security fluctuated up and down? How has the volatility moved according to the securities up and down? This is what is captured by the historical volatility. So historical volatility, or HV, shows you the past data, whereas IV shows you the projected data. So this is, both the IVs and HVs are a subset of the major volatility index, which is known as a VIX. So this is all that volatility is all about. So if anyone wants to refer to any more details, surely they can visit our old webinars where I've already covered volatility in much detail just on the subject itself. So let us understand how the IV and the HV is going to affect, how this volatility is going to affect, what kind of strategies can you do to hedge your positions is what you can come up through. So, what we're going to cover in this webinar session. So usually if the IV is greater than the HV, the traders believe that the option premiums are overvalued. And if it is, or the IV is lesser or lower than the historical volatility, traders believe that the options are undervalued. Now this is all about the volatility. For many, sure, very few of us must have heard of something called a volatility skew. So it is important for us to cover volatility skew to realize how the market participants are reacting to different option premiums, and why is there so much of difference in different option premium. So what is volatility skew? It is nothing but the difference in IVs, which is your implied volatility, between out of the money, at the money, and in the money options. So the difference between OTM, ATM, and in the money options, that is ITM, the difference in the IVs is something called the volatility skew. It is affected by sentiment and the supply and demand relationship. Obviously, there's a supply and demand of all the different strike prices of the options, and that difference in this supply and demand relationship is what causes a volatility skew. So volatility skew occurs mostly because there are money managers, these fund managers, who would prefer to write calls over put. So the majority of the market participants, they hold long stocks, usually over long term. So what happens is that these investors, they go into the market, they purchase the portfolio insurance. What is a portfolio insurance? It is insurance in the stock market that comes in the form of long put options. Usually they are deep out of the money options. But what happens when people purchase options? It can result in two things. It drives up the price or the premium of those options, and also the volatility of those strikes. We compound this even further by noting that when it comes to writing options, the majority of this is done through writing of call options, which usually happens in the form of covered call. Covered call is where you have stocks in your portfolio and you write out of the money call options to protect or to gain out of those time value in the or call option. So this is something called covered call. So when you sell options, the price and the volatility lowers in those strike prices. So there's a difference. So when you're purchasing options, the price is increasing, the volatilities also tend to increase of those strike prices. And when you're selling option, the price, it drives the price, but the volatility is lower in those strike prices. So this is how we get a higher volatility for out of the money put options and out of the money call options. And this is the reason why this volatility skew is usually existing. Now there is also something called a volatility smile. Skew, we've understood, it's a difference between your call options and the put options. If your put options are more than your, if your put options are written more than your call options, then there's a skew that exists. But why does a skew exist? The reason is that there's a supply and demand for these options. There are different strike prices. Every investor is investing in a different strike price, but the expiry date is being shared. So there's a shared expiration date. Underlying product remains the same. However, those strike prices can vary because maybe I am doing in one strike option, you may be doing in another strike option. Although both of our underlying product is the same, the expiry is the same, but there's a difference in the strike price. Hence, this is the reason why the volatility skew exists. But what happens when your current at the money options, they have lower IVs and out of the money options? In this case, we get something called as a smile. Why smile? This is where you can see. So your midpoint is at the money options, and your left and right you've got out of the money and in the money options. So you can see from the midpoint your IVs are lower, and as the stock or the strike is moving to out of the money or in the money, the IVs are increasing. Hence, it is forming a smile. So a lot of people, a lot of traders, they can take this advantage of volatility smile, and they can do a lot of strategies accordingly, which some of these strategies I have shared in the further slides. So this is how a volatility smile looks, and the opposite of this volatility smile is your volatility skew, where the IVs are decreasing as the strike prices move from in the money to at the money, then from at the money to out of the money. This is how the volatility skew is. So there is the opportunity available when there's a smile. There's no opportunity much when there's a skew of it. So we have understood this volatility skew in a very basic and a crisp manner. Let us move forward to see where you can actually track this volatility skew in your options chain. Option chain, you can check it out from the NSE exchange site itself, and also you can check it out from a pro terminal. So this screenshot that I have in front of me is the screenshot that I've taken from the pro terminal. Here you can see there's this option chain, all the call option strike prices and the put option strike prices. On the right hand side is a put option, on the left hand side is all your call options. If you can see, currently, if I would say the current market price is 10,200 or something, and you can see 300 points below the strike, 300 points below the current market price. If I'm choosing a strike, on the put side, the yellow arrow you can see that's pointing towards the implied volatility of the 9900 put strike option, which is at 33.16. On the left hand side is your call options. So if you go 300 points above your current market price to check the IVs of that strike, that is 10,500, you are seeing the Volatility, the IV of 10,500 call option is 28.05. So there is a difference between the IV of the put options and IVs of the call options. So it is the difference that you can see is what is causing your volatility skew. This is happening probably because of the market sentiment where people are taking a lot of position in the put options in compared to the call options. So that is the reason why the IVs of the put options tend to increase a little further than the IVs of the OTM call options. The reason is because people tend, like I explained, the market participants, they are holding the long stocks, they buy put options to hedge their position. So this is where you can track the IVs and the call option. And you can see as these strikes are decreasing in case of put option and these strikes are increasing in case of call option, it means that as these strikes are getting more and more deep out of the money, the IVs are increasing. At the money, IVs are very minute, so it's lesser than the IVs of the out of the money options. So this is how volatility skew can be captured from your option chain. Now we'll move on to the hedging strategy. The first hedging strategy we have for the day is something called a married put. What is this married put? It is similar to an insurance policy for investors where you're holding stocks, you want to protect your stock from any immediate downside movement. So option strategy where the investor is holding a long position in a stock, you can buy an at the money or out of the money put option on the same stock to protect the downside. This is called your married put. In other terms, it is also known as a protective put kind of a strategy. So strategy is done when investor is concerned about some potential near-term uncertainties in the stock. So you're holding the stock, but you're also concerned that in the near term, in the short term, there can be some kind of uncertainty or movement coming in the stock. So this is where you can do a married put. But for the strategy to be a married put strategy, the stock and the put option must be bought on the very same day. Then only this becomes as a married put strategy. So this is more like a capital preserving strategy as the cost of the put option is already considered as a built-in cost of your total entire strategy. And this is how your payoff diagram will look. So you can see that your loss gets limited and your profit can be unlimited. So how your profit is unlimited and your loss is limited, we'll see in a simple example in the next slide. Hypothetically, I've taken the example, supposedly the current market price of Nifty is 11,000 and the lot size of Nifty is 75 as we all know. So the position that you have taken is you have bought one lot of Nifty futures. To make it into a married put strategy, you are buying either an at the money or put option or out of the money. In this case, you can either buy 11,000 put option or 10,900 put option. That would depend on the strike that you want to choose. So how can this be considered as a loss risk limited and profit unlimited? What happens if Nifty goes to 10,500? It means that it is 500 points below the current market price and below the price that you have bought the futures. So loss from Nifty position alone that you'll get is 37,500. How? 11,000 is a buying price, 10,500 is current market price. So the difference is 500 into 75 comes out to be 37,500. So if you hedge your position, how can you reduce this loss? Because you are buying 10,900 put option, for example, at 70 rupees premium. Your loss would only be 12,750 instead of 37,500. How? Because when the market is going and the Nifty is falling to 10,500, the put option premium will go from 70 rupees to 400 rupees. So 400 into 400 minus 70 is 330 rupees. So tentatively, the profit that you're gaining from this 10,900 put option that you have bought is 330 rupees. You bought it at 70 and you're selling it off somewhere around 330. So 330 into 75 comes out to be 24,050. And if you subtract that from 37,500, your loss remains only 12,700. So if you only take the position in Nifty and you're not hedging your position, your loss is coming to 37,500. But if you since you have hedged this position by buying a put option, your loss will only be protected till 12,750. So how much are you saving in your loss? It would be 24,750. Now, even if the market or the Nifty has to fall to 10,000 also, then also your loss would remain in only 12,000. Instead of going ahead and making a loss of 1 lakh, you are fixing your loss, you're protecting your loss at only 12,000. So this is how you are saving a huge amount of loss. What happens if the market moves up? So if Nifty goes to 11,500, your put option that you have bought at 70 rupees will expire worthless. It means that it will turn zero. So 70 rupees is what you're losing straight away. So 17 to 75 comes out to be 5,250. But the profit that you're gaining from the Nifty option is, sorry, Nifty position is again 37,500. How? 11,500 minus 11,000, the 500 points into 75. So that comes out to be 37,500. So your total net profit will be 37,500 minus 5,250. That comes out to be 32,250. And this status would be that if Nifty keeps on moving ahead, if it goes to 12,000, your profit will keep on increasing. So by doing a merit put strategy, you are fixing your loss at all certain time, at all downside movement, possible downside movement, and your profit still remains unlimited. So this is how you are saving your losses. You're protecting your capital, you're protecting your loss, you're giving it a fixed loss scenario, and you are hedging a position, but you still have the potential to earn the profit unlimited. So this is the example of a very simple married put hedging strategy. Right? So moving on to the next kind of strategy that one can do, something called as a collar strategy. So now, as we know, the market participants, they hold the long stock, they'll buy put option. So there is always this cost attached to it. So many traders, many investors would not want to invest so much and give pay this cost as a premium, as an insurance premium. So they would not want to pay this cost. How you can reduce this cost? There are a lot of spread strategies that you can do to reduce the cost. One of this is a collar strategy. So your construction would be you're holding the stocks in your portfolio, you're purchasing the out of the money put options. Now, to reduce that cost, you are selling an out of the money call option. So what happens is the put option premium that you're paying, you're receiving some premium from the sold call option. So plus minus, you're getting something. So your net premium, their net cost reduces. This kind of a strategy, this collar strategy, is done only when your view is mildly bullish and you wish to protect downside movement in the stock. But this kind of a strategy is not suitable for the traders who are extremely bullish and they expect a huge large price rise. So if you are okay with being mildly bullish, you are expecting that the stock will rise, but there can be some downside. So I need to protect my downside. You can do the collar strategy. Let us see how you can gain a maximum profit out of this collar strategy. It would be the option strike that you have, the premium less the underlying stock's purchase price per share. And the maximum loss would be the purchase price of the underlying stock less the put option strike price. Obviously, the cost of the option is already factored in, it is already built in. And this is how your payoff will look like at all points of time. So your loss also remains fixed, your profit also remains fixed. But by doing a collar strategy, you have essentially reduced the cost of your hedging. Now let us look at this with the help of an example. Now assume you have some shares, ABC shares. You are buying 1,000 shares of this ABC stock at 50 rupees per share. The current price has fallen down to 47 rupees per share. To hedge your position, you are buying 10 lots of put option with a strike price of 45, and you're also writing or selling 10 lots of call option with a strike price of 65, a little higher, quite higher. So you are paying a premium for buying the put option, that is 2.50. You are getting some premium by writing the call option, that is 1 rupee, for example. So your net debit or your net premium paid would be only 1.5 rupees premium. Your maximum profit would be the 10 contracts that you have bought, now each contract assuming is has a lot size of 100, so your 10 contracts into the 100 multiplied with what, your call option strike that you have sold, that is 65, minus your purchasing price of the share, that is 50, minus the net debit premium paid, that is 1.5. So your maximum profit will come out to be 13,500 at all point of time, and this would happen only when the stock is increasing or rising above your strike option that you have sold, that is 65. Whereas your maximum loss can be only 6,500. How? The price that you have bought the shares, that is 50, minus the put option strike price that you have bought, that is 45, plus the premium that you're paying, because this here is the net premium that you're paying. So you have reduced your cost from 2.5 to only 1.5, so it becomes your only cost. Multiplied with 100 shares, multiplied with the 10 contracts that you have bought, it comes out to be 6,500. And this kind of a scenario would only be when the stock is dropping below 45. So, how is your total loss that you have saved? How much is the total loss that you have saved by hedging? For example, if the stock falls to 40, the loss that you are incurring from the ABC holding, ABC shares holding alone is 10,000 rupees. How? The stock you bought at 50 rupees, stock has fallen to 40 rupees. Shares you had was 1,000 rupees. So 40 into 1,000 is 40,000. Your purchasing price was 50,000. You're losing 10,000 over here. But if you have implemented this caller strategy, that is, you have purchased that put option, you have and sold that call option, then your maximum loss scenario, as we discussed, is only 6,500. So your total loss that you are saving in this case of a scenario is 3,500. So instead of 10,000 loss, you are saving 3,500. So your max loss remains to only 6,500. Now, what would happen if the stock falls further? If it falls to further 35, let's see the scenario in this case. So, if it falls to 35, the loss that you are incurring from the ABC holding is 15,000, which is 15 rupees into 1,000, comes out to be 15,000. The max loss that you are getting from the caller strategy that we have implemented, as we discussed, is 6,500. So your total loss that you're saving is 8,500. So instead of giving away a loss of 15,000, you are saving 8,500 loss, because your maximum loss is fixed over here at 6,500. So this is how you are doing, you are saving your loss, you're protecting your loss at unlimited fall downside that you can see in the stock. However, you can hold the stock for the long term, and if the stock rebounds from there, your profits will start to come in again. So this is another advantage of the caller strategy. And if you're not taking the put options, this caller strategy is simply converted into a covered call strategy, which is also ideal for portfolio hedging. So this is how a a caller strategy, a merit put strategy, they differ. Merit put has a limited risk, unlimited profit, but a caller strategy, hedging caller strategy, will have limited risk and limited profit. So these are the different kinds of hedging strategies that you can do. Some more volatility skew strategies that you can apply, maybe with spread. So how it is done is that there are traders who also trade in that skew. If you remember that smile and the skew we shared in the first slide, so a lot of traders, they also trade the skew by using spreads. How? They buy the cheaper or the lower IV options, and they sell the expensive or the higher IV options. The view is to actually profit out of the implied volatility and not on the direction or the movement of the underlying stock. So people or traders who are trading the skew, taking advantage of the volatility skew, their view should be to profit out of the IVs. The view should not be to profit out of the direction of the underlying stock. And to reduce more the cost of hedging, you can also go ahead with applying more spread strategies, such as bull and bear put spreads. Bear put is nothing but where you are just buying a put option against your long portfolio, long portfolio stocks. You're buying a put option, So simultaneously, you would also sell a put option, a lower strike of a put option, to make it a bear put kind of a strategy. So here you are buying the higher strike of the put option and selling the lower strike of the put option. For example, if the ABC stock is currently at 500, for example, you are hedging it by buying 480 put option. To reduce the cost of this hedging, you are additionally selling a 460 put option. So in this case, you are creating a bear put. But there is only one disadvantage to this kind of a bear put come hedging strategy, spread strategy with your long stock portfolio, is that your downside protection will start to subside beyond a point. It means that it will not give you a very proper hedge if the stock keeps on falling to maybe 400, 300, 200. So your bear put strategy will limit your loss to a point, but it will start to subside beyond a point. So these are the various strategies that you can do, taking advantage of the volatility, high volatility, low volatility, taking advantage of the IVs, the options premium, different kinds of strategies, reducing your costing, all with the help of options. And if you do not want to hedge your portfolio or your position with options, there is something called as a beta hedging, which is done through futures. And this is for people who do not want to go ahead with the options hedging. How is the beta hedging done? So to understand the beta hedging, let me just give you the example, or a definition of what beta is. It is the systematic risk that is measuring the movement of your stock against the movement of the market. So if my market is moving by 10 points, how much should my stock move? That calculation or that measurement is done through beta hedging. So in this example, I have 5 stocks. I've taken random names: ABC, DEF, XYZ, PQR, and STV. And I have also mentioned the stock value of these particular stocks. How much is my investment? For ABC, I have invested 4.5 lakhs, DEF 5.5 lakh, and so on. So my total value of my holding is 22.3 lakhs. I have also mentioned how much, out of my total value, how much is my each stock's weightage. So ABC is accounting for 20%, DF is accounting for 24.6%, and so on. Now I've taken these stocks beta individually from, it's readily available in exchange sites. You do not need to have any softwares to find out the beta. So I've just mentioned the stock beta and I've calculated the weighted beta of each of this stock. How to hedge? Go for beta hedging. If your total weighted beta of my entire portfolio, you can see, is 1.26, I've calculated the total weighted beta. So my value of the futures that I need to sell or short would be 28 lakhs. How did I arrive at this? It is simply multiplying my total portfolio value holdings multiplied with my weighted beta. So 22.3 lakhs multiplied with my weighted beta, that is 1.26, comes out to be 28.14. So this is the value of the index futures that I must sell for hedging my stock portfolio. For example, if the current contract value, for example, if I'm going ahead with selling Nifty index futures, then I will have to find out the contract value of my Nifty index futures. How to find out the contract value? It is your current market price multiplied with the lot size. So if the current value of Nifty, for example, is 7.87 lakhs, I can divide my total value that needs to be shorted by the contract value. That will give me how many lots I need to sell to hedge my portfolio of this particular, which is 28.14 lakh divided by 7.87 lakhs, comes out to be 3.57 lots. So obviously you cannot do 3.57, you can round it off to 4 lots of index depending on the view. So to protect my value, to protect my stock portfolio beta hedging of 22.3 lakhs, I need to sell 4 lots of the index futures. So this is how beta hedging is done. So now we have done the, separately we have covered the options hedging, we have covered the beta hedging. And I've just taken one more small screenshot from our platform, advanced trading platform called Pro Terminal, where we have something called as a strategies. You just need to input the target price of your stock or the index that you want to find out, take a target date, Click for these strategies, and a pro terminal will calculate these strategies by default for you. So if you do not even understand options and how to make it into strategies, you can directly do, go ahead, subscribe to a pro terminal, click on those strategies, give the target price and the target date, and the pro terminal, our platform, is going to calculate these strategies for you. And you would get a maximum of 5 strategies at any point of time. As you can see from the screenshot below the click here for strategies, you can see there are 4 strategies: bear call spread, long call butterfly. So these are the different kinds of strategies that you can get. So initially you can take the help of pro terminal to understand how to build strategies, what kind of strategies give you what kind of returns, what would be its benefit, advantages, disadvantages, the payoff, what is your maximum risk, maximum loss, maximum profit. Everything is calculated in this pro terminal. So initially you can take the help of this pro terminal. Right, so this is all about today. So I think it is very important for us to understand volatility. Let us first understand the skew also. Again, let us compare the put option premiums with the call option premium constantly to see whether they are overvalued or undervalued, whether the put option premiums are more expensive, and if it is more expensive, whether you should buy them, or you should wait for the premiums to dip. Similarly, comparing it with the call option premium. So this is how you can determine the entire option pricing through the volatility skew and through this entire webinar. So I hope it was useful for you. The strategies that we have covered on options, such as married put strategy, caller strategy, covered call strategy, and also how to protect and hedge your portfolio when it comes to beta and going through index futures, or beta hedging, that also we have covered. So constantly we are trying to keep coming up with such, explaining such simple strategies to all our investors, to all our traders who are viewing us. So keep viewing all these webinars. We'll again come up with more and more strategies to make it more simple and explain it to you, that would be beneficial for you. Right, so this is all that we have for this session. Thank you so much. Now let us move to the question and answer round, if there is any. Okay, we have questions. So Mr. Nitish Mishra is asking the first question from Mr. Nitish Mishra: how to perfect hedge the future position and volatility so that we can protect our capital or margin. Right. So Mr. Nitish, again, like all the strategies that I've covered, one is this married put strategy. That is a very good strategy, especially when you are taking a fresh position, maybe in a stock or the index. You can buy a put option and you can protect your hedge your position. And if you want to reduce your cost of that put option premium that you're buying, you can go for something called like the collar strategy. So on a continuous basis, you can keep doing these kind of strategies until and unless your stock that you're holding in your portfolio for a long term does not rise and move up. So to the level that you want to sell it off. So that is one kind of strategy that you can do. Now, Mr. Sham is asking, how do we find out how do we exactly find out to use the options when the prices go up? So again, Mr. Sham, how to understand the option pricing? So in one of my derivatives webinar, I have made it understood, like, yeah, I've covered the points, important parameters where the option pricing gets affected, like the underlying price, the strike price, the expiration date, interest rates, volatility. All these are all the parameters. So why a call option or a put option price would move up? It has a lot of reasons. One of those major reasons is volatility that we have covered today. Like we covered, the IVs could be high if the VIX is moving high, or if the volatility is high. It is considered that the option premiums are high. If the volatility is falling, it is considered that the option premiums are also decaying or falling. So this is how volatility has a direct impact on the options pricing. So if you want to understand how the option prices are expensive, you need to compare that with the call option prices, the put option and the call option prices. So you can cover the IVs, you can read the IVs like I explained from the options chain. Go to the IV section, compare if the IVs are rising in the case of out of the money options. Compare the put options and the call options, compare their IVs and see if there is a huge difference. Then you would know that there is this volatility skew that is taking place, and with this volatility skew, you would understand that the option prices are more overvalued than it should be. So this is how you can understand. So another question is from Mr. Devendra, who's asking if it is the right situation to hedge. Certainly, sir. See, hedging is something called like an insurance. So it is protecting your capital from being lost. If you would ask me personally, I would advise that I would not advise. I would say that it is uh, always a right time to hedge, because nobody knows how the market is exactly going to be tomorrow. When you are investing your hard-earned money in the capital markets, or you're investing it in anywhere, you don't want to lose your capital out of it. You don't want any negative event coming in where there can be a scenario or situation where you're losing all your capital, right? So to protect those capital is why you need to hedge. So if you'll ask me, I would say that it's always a right situation and you should always go with hedging. Even if to you personally the market seems extremely bullish at any point of time, or the stock seems extremely bullish, and you are 110% sure that the stock will move up, which is for sure it can. But even in that scenario, it you can still hedge your position, to just understand it a little, to just hedge your position to cover or protect your losses in case overnight there is any negative event coming in. So Mr. Muttuza Munimi is asking if there is any way to backtest our strategy before we put our money. Sure, so I think you can go in Excel and you can backtest your strategy. It's something called as a virtual trading. You can do it in Excel. You can see how the different hedging strategies work out for you. There are a lot of hedging strategies. I've only covered a few. So it might suit to some, different people with different views on the stock and the market. So the best way would to backtest would be do it live, do it in your Excel sheet, maintain that record, do a virtual, hedging kind of a scenario, and see where the market moves. If it's moving according to your view, or if it's moving against your view, and how exactly are you benefiting out of it. So that is how you can backtest. So Swati is asking, in your first slide, you said that in case of Nifty goes down from 11,000 to 10,500, the put option gain is 300. That is 400 minus 70, 330, sorry. So the question is how it is 400. In most case, it is seen that it would be around 250. Interested to understand these things. So how I've calculated this is in the basis of the expiry. So a break-even point is always calculated on basis of expiry. So the difference between 10,500 and 10,900 is 400. So when it's a put option and the market has gone below your strike price, it becomes in the money. So obviously your price will increase when it's in the money, because the market is going down, your put options will increase. So from 10,900 to 10,500 that the market has gone, your put option difference between the strike and the spot price is 400. Why? Because in the money options have something called intrinsic value, which I've covered in one of my webinars if you want to understand that. So you can go through that. So all the in the money options will have intrinsic value. So in this case, when 10,900 put option becomes in the money, the difference between the strike and the spot price is 400. So ideally, it is always calculated that this strike will expire somewhere around 400 rupees. It may be 390, it may be 405 also. That difference that it happens, that we usually see 390, 380, 385, 95, 400, 402. So that is where it is about to settle, and that is where this volatility skew actually comes in to the picture. But ideally, in and around approximately it is 400. So I also have calculated this in the similar fashion. So 400 minus 70 is 330, multiplied with one lot, that is 75. So that's how I've calculated. So you must understand, to understand where the options must expire, you must understand if it's out of the money, in the money, or at the money. If it is in the money, they would have intrinsic value. If it is OTM and 18, they'll not have any intrinsic value. So Mr. Govardhan is asking what signifies a PC ratio, that is a put call ratio. Yeah, Mr. Govardhan, we have covered this put call ratio in one of my derivative decoding derivatives webinar. You can search for all of our webinars on the YouTube channel itself. Just go and subscribe for HDFC Securities webinar. You would get all the webinars that we've done till date. You can review even this webinar in the YouTube again, back again. So if you want to understand entirely basics, many people are asking how to, if they are new traders, how to begin with new trading to understand derivatives. So we have covered all of these things. So we have covered exactly what is derivative, futures, options, the important parameters of it, indicators of it, such as open interest, put call ratio. So I would request that you can seriously go and, you can just visit one of those, you can view one of our webinars again to understand all of the significance of these parameters as well. So Swati again is asking, can we hedge futures position either long or short? Absolutely. So futures, you can take a long position. You can also take a short position, because whether you take a long or a short, you have the unlimited profit, unlimited risk kind of a scenario. So you can hedge both. So hedging is just taking the offset or the contra position. Whatever you have the position line, if you do the opposite of the contra position, that becomes a hedging. If one falls, one would profit. So this is how hedging is done. So you can certainly hedge your positions, whether even if it is long or short. Right. So I think there are a lot of other questions which I would like to answer. I would personally try to get everyone to answer all these questions directly to your email IDs. So I think this is up for a time right now for this webinar. Thank you so much once again for viewing this webinar. I hope you have seriously benefited out of this. Hedging, very important. Let us understand how the market can be very volatile at all times. Stay hedged, learn the hedge, learn all these hedging techniques. Remain hedged, protect your capital losses is all that I can always say in the end of the day. So look out for more of our webinars, more of the option strategies to cover. There are a lot of strategies we would try to cover at the simplest form that we can. So look forward, look ahead to our webinar, upcoming webinars and upcoming phone calls. And thank you so much once again for joining this. Thank you.